Hi, my name is Ruth McCambridge, and I'm the editor-in-chief of the Nonprofit Quarterly. I want to welcome you today to our webinar, Preparing for the One Big FASB Change in Nonprofit Financial Reporting. We're very proud to present this exciting event today, featuring Hilda Polanco, founder and CEO of Fiscal Management Associates, otherwise known as FMA. Hilda will grace us with her rendition of the key changes in the reporting requirements from FASB. As you likely already know, these financial reporting standards have recently been updated for the first time since 1993. And although the changes are meant to improve the communication of financial results to your donors and other outside stakeholders, a prospect that will improve your financial management, some aspects of the changes really do require your advance attention. So that is what we are focusing on today. Today's webinar, before we go on, today I want to say that the reason why we can bring you these webinars for free is that they are sponsored. And so today's webinar is brought to you by AccuFund, a nonprofit financial management specialist, helping thousands of nonprofits improve their overall financial management by streamlining processes, improving efficiencies, and lowering costs. Their solutions are available on your premises, or by cloud. Their reporting capabilities and intuitive dashboards enable sound decision-making and strategic execution of your mission. This webinar will be recorded. And so don't ask me that. Everybody always asks me that like a million times during the webinar. So everybody knows now this webinar is going to be recorded. It'll be available to you in total on our website on an ongoing basis. We're also going to send it to you right after the meeting. We will also make the recording of it. I've said that. We'll make the recording available on our website, and that will include all of the slides. So we're going to leave time for questions at the end of the webinar. So if you have one, I want you to feel free at any time to log that question into the box on the right-hand side of your screen. That's where we're going to, we'll pick and choose among the questions according to what's already been answered. But also, after the webinar today, we are going to have a LinkedIn discussion for about a half an hour. And to go to that, to ask your questions, we're going to ask you to join our LinkedIn group at Nonprofit Quarterly to participate. And in helping Hilda to answer the questions in that section of this event will be Gina McDonald, who's a senior consultant with FMA as well. Now back to today's very exciting topic of what's really important for you to think about in advance in terms of the new FASB guidelines. Of particular importance, the guidelines will require an enhanced disclosure of the board's policies to manage your organization's ability to pay its bills, even during times of difficult cash flow. Before you can disclose your policies, however, you first need to have them. So this is the aspect of the new guidelines that I think will take a lot of people by surprise, is that you actually have to have a cash flow plan or guidelines in hand as you move forward. It's a new requirement. This one point requiring liquidity planning will need a good deal of preparation on your part. Hilda will explore the importance of defining a framework for managing liquidity, including establishing reserves, securing a credit line, accessing endowment earnings if you have them, and other strategies to make sure that in times of tight cash flow, your nonprofit can pay its bills without interruption, and have the clarity, and that you have the clarity necessary to share that framework externally as part of the ongoing financial story told by your audited financial statements. This is a big change, and it does require some forethought, and to describe what is going to be required of you and how you might want to begin thinking about this, I present to you the awesome and glorious Hilda Polanco, who basically can translate any obscure financial concept for you into whatever language you speak. Right, Hilda?
That's right. Thank you.
Maybe not whatever language, but at least into English. So, Hilda, take it away. Thank you.
Thank you, Ruth, for that introduction. I will certainly speak English for this afternoon. I'm just looking to advance the slides. 1 second. Just as we're forwarding our slides here, I wanted to start by saying that in the past, we've always thought about financial accounting standards, FASs, and there has been some global change in updates in the accounting world. And now, just to add more acronyms to our world, they are forever going to be referred to as ASUs, Accounting Standards Updates. So we no longer have financial accounting standards, we have audit accounting standards updates. And today we're focusing on ASU 2016-14. Hopefully that's the last you'll have to hear that set of numbers. The ASU was issued in August of 2016, and it has been a major revision on many levels. We'll talk about one particularly today, but there are several ways that the auditing standards, the accounting standards have been updated. And a question I know is top of mind for everyone: when is this effective? When are all these new rules something we need to worry about? For calendar 2018 or fiscal year 2019. So thinking of a calendar year organization, 2017, we're about halfway through. 2018 will be the year where these rules will be effective, and you'll have 2017 to think about, and then 2018 to actually have them in place. The focus of the ASU is around how others can better understand and make decisions around your financial statements. For those of you on the call that are not subject to audits, this is something more that perhaps you'll have conversations around more informally, but if you are audited, it is part of the accounting standards. And this is to be used by board of directors, by donors and funders who are always interested in understanding the financial story, maybe even financial institutions that you might go to for purposes of liquidity and for debt. There's a couple of things I wanted to share, which is what comes to mind with this ASU. First of all, is what is changing? And in the financial world, there are three different aspects that we are in control of. There's the accounting of everything that happens in our organization: revenue in, expenses out, capital assets. That's the accounting inside the system. Then there's the financial statement presentation that we use to communicate our story. And then there are the disclosures that are required. And as far as accounting, this ASU is not changing the accounting system per se. It is changing and refining some of the presentations in the financial statements. So revenue is still recognized the same way. There are just different classifications, as you'll see in a minute. So the presentation of the financials has been changed, and the disclosures. And disclosures have been changed for the more. We are expecting to have to develop disclosures and descriptions of certain aspects of our financial health, as you'll see in a minute. So it's really about the financial statements and the actual disclosures. These are the 5 major provisions where changes are taking place. It would not be wise for us to attempt to cover all 5 in this hour together. And so we are going to focus on the first one on my chart here: liquidity and availability of resources. I'll come back to that. I did want to just briefly make you aware so that you can make note based on your financial results as to which of the other four you may want to pay attention to in the future, other webinars, other information you might read about. On the expense side, many of you already provide a statement of functional expenses. In the future, if you don't, you will be required to. And so the preparation of the statement of functional expenses, which by the way, needs to be for your 990 anyway, is something that may be new to some of you. But not just the preparation, but the allocation plan that goes behind those allocations that lead to the functional presentation. That is something that you'll have a bit more conversation with your auditor about when the time comes. Investment returns, this is around netting of some of the expenses related with attaining the returns. I'll just leave it at that. So if you have significant investments, you'll want to pay attention to the disclosures and calculations of net investment returns. The statement of cash flows has always had two different methodologies, a direct and an indirect, and there is a requirement to do it a certain way now. I happen to think that it's a clearer way to present the cash flows of an organization. Again, something you'll want to look into. And then lastly, I think for many of us, the net asset classification will affect us. And the highlight there, and you may have read some of this already, today we have three classes of donor contributions: unrestricted, temporarily restricted, and permanently restricted. We will then be going to two classes, with donor restriction and without donor restriction. And so for all of us, I think that will be something to also look into as we try and get our head around all of these provisions. Today, as I mentioned, we're going to cover the liquidity and availability. And when we planned the webinar, we thought, well, of these five, which one do we think people should start thinking about sooner rather than later? And this was by far the one we thought would require a little bit more thinking. You'll see in a little bit why, but it's really the requirement for disclosure assumes that you have a certain set of standards and guidelines internally for your management of your resources. And oftentimes we hear the word you're telling your financial story. You want to do that in the clearest way. The disclosures that are going to be required with the audited financials aim at being able to give clarity around liquidity, which I think is top of mind for all of those stakeholders, the board, the donors that you might be sharing your audits with, and certainly any financial institutions. And so focusing on that for the day, it's a future-focused disclosure. Many disclosures, I would say almost all disclosures in the audited financials are about the past. It is about what has happened. This is more about the future to help the stakeholders be able to assess, do we have resources, enough resources to meet the cash requirements that we may have? And what is the liquidity and financial flexibility? These are the goals. And as many of you might know, the goals when projects like these begin aren't always necessarily what you feel is the outcome, but this is the goal. And together we'll explore what this means for you, the financial statement preparers, who are going to start to think about it. So these two words, liquidity and availability of resources, there is a lot behind those two words, and I'm going to take it in parts. So there are two types of disclosures around liquidity and availability. The first one is qualitative. It is in words. How does the nonprofit manage its available liquid resources? We have some examples to share with you this afternoon, and there aren't many examples out there yet because the ASU is new. There are some possibilities for early adoption. I don't encourage anyone to go and run and try and early adopt. There may be some major organizations that do, and when they do, we'll have something to look at as examples. But I would say that most of the nonprofits in the country are going to wait until it's mandatory, which were those dates that I gave you. So qualitative, in words, how does an organization manage its liquidity and its resources? And then quantitatively, what is the availability of resources? And this sentence that goes on for a few lines here, every single word has a specific meaning. So financial assets means something specific. Not every asset on your balance sheet, but which assets are available to meet the cash requirements for general expenditures. And general expenditures isn't necessarily defined in the ASU, but there is a general sense that it is to cover your ongoing operating expenses for the organization's business. So financial assets available to cover general expenditures within 1 year. Liquidity is usually thought of as a measure of access to cash. We often say cash is king, and the availability of it within 1 year, within the world of nonprofit accounting, think of those as your current assets, the assets that are available either in cash or almost cash within the coming year. So as we walk through the examples, you'll see a qualitative example coupled with the quantitative. It is a hand-in-hand disclosure, so every organization's footnote will have the words that are then shown in numbers. In terms of what each of these mean, I'm going to dive into these a little bit in more detail so that you can envision what your financial disclosure might look like. So the sentence, available financial assets to meet cash needs for general expenditures within a year. Let's dissect that a little bit. What are financial assets? We start, and you'll see in the examples, and the example I'm going to share with you is largely based on an example that appears in the ASU, but I think, as I said, we'll see many interpretations of this as it unfolds. Financial assets start with total assets, but then we ask ourselves, well, what's in fixed assets? Fixed assets are our buildings, our hard assets like equipment, leasehold improvements. Those are not available to meet our needs within a year for cash. So we want to subtract any fixed assets. We want to subtract any prepaid expenses because even though those are assets, we've paid for them in advance, we've already paid for those. Those are not resources available to pay other bills that might come our way. Inventory. For nonprofits that have inventory, we wouldn't count that because, again, those are assets that will help us, not available cash to pay our bills. The ASU doesn't necessarily mention other illiquid assets. I'm adding it to the definition because you may have things like investments in subsidiaries that are not liquid and available. You might have long-term security deposits with leases not available to meet your requirements in the coming year. And when we're done with that calculation, we come to financial assets. This is assets. We have not spoken about liabilities. We are clearly speaking about assets that are available. So when you think of your financial statements and you just quickly look down your balance sheet at your current assets, you're probably going to start there and then adjust with prepaids and insurance, and then your fixed assets would be in the long-term section. So that's financial assets. Let's now look at another aspect of this, available. Even though those financial assets, as we've defined them, exist, availability is based on whether there are internal limitations or external limitations or no limitations at all. The availability means that there are no limitations for you to use them for the general expenditure. So we start with financial assets, and then we ask ourselves, do we have any internal limitations such as board designated funds? In my previous slide where I started with total assets, I might have $50,000 in the bank, but of that $50,000, the board has set aside for operating reserves, for emergencies, for capital replacement, $10,000. So even though I have $50,000 in the bank, I really don't have 50. I only, in my example, have 40 because that $10,000 has been set aside as a reserve. And so internal limitations by the board would be reducing the financial assets that are available. I'm going to come back to that in a minute. We would also decrease the financial assets for any endowment principal. Endowment principal is never to be spent. So if it's in our assets, we need to back that out. And here comes, I think, the trickiest question, the question that will be most debated, and that I think even today I have healthy debates with other professionals about, which is this question of, if I have temporarily restricted net assets, either in cash or donor grants that I have received, and I want to know, are my financial assets to cover my general expenditures for the coming year sufficient? Do I get to count my temporarily restricted net assets in my available resources, or do I not? The disclosure requirements in the standard are not very clear here. And last week I was at the AICPA conference where we had 1,500 CPAs all together, many of us sitting in one room listening to the FASB update, where it was acknowledged that this is really up to the definition of the nonprofit. If you believe that the restricted net assets are intended to cover, even though they're restricted to a particular program, if they are intended to cover operating expenses that you consider part of your general expenditures, your ongoing business model, they would be available. You would not decrease them because they are there available for you to use to cover your general expenditures. General expenditures doesn't mean not restricted activity. It means all of your expenditures. It doesn't mean things like a capital campaign or a one-time, a brand new program you might be bringing up that you would only bring up if you had enough funds to start the program. So then you would back out those restricted net assets because they're not available. But if they are available for general expenditures, then you would get to count those. And many of you have been following our webinars where I've spoken about LUNA over and over again, liquid unrestricted net assets. And we ourselves, as advocates of that concept and that metric, are reconciling within our own minds. So what's the difference between LUNA and all this stuff about available net assets? And when we think of LUNA as the most conservative estimate of liquidity because we have backed out all liabilities and we've backed out all restricted assets. LUNA is absolutely what is liquid, available, unrestricted, no board designations, available for any risk. These definitions in the standard are a bit more generous in that they're not even getting to the liabilities section in this draft of the ASU. And this was a question that came in already from the audience before the webinar started. This financial asset definition stops at assets. As we go through the slides, you won't see any discussion about liabilities. I wasn't at the standards board meetings. I couldn't tell you exactly how they got to this conclusion. In the interpretation, and we'll see more examples through the years, I think it's all in the context of bills that you need to pay within a year. And so I wouldn't be surprised if this gets tweaked in some way or further clarity around the disclosures indicates some reference to related liabilities. Right now, it's a bit gray in that it speaks of financial assets available for general expenditures within a year. That, of course, means liabilities that you have as of today, as well as the expenditures that will come your way in the coming year. So again, this is new territory. I've been trying to piece together all the guidance that's written in the ASU, what was presented at the conference, and just it'll be interesting to see how it unfolds. So again, available, the definition of available means they're not restricted by a board reserve fund of some sort. They're not restricted by a principal endowment. And they are or are not restricted by the donor based on the nature of the temporarily restricted net assets. So we have a question mark here to remind us, do we back it out or do we not? Another question that came from the audience before the webinar started was around this question of board designation. And in the way that we introduced the webinar, we had said you need to disclose your board policies, which means you need to have them. And if you have a policy that says we're going to have a certain amount of cash reserves, we're never going to go into debt, we're going to maintain our liquidity in this way. This was the question that came from the audience. You would just have a policy that says that. We have a reserve policy of X thousands of dollars or X months of operations. They are invested in money market accounts, and they are available for the following reasons. And that is what we often refer to as operating reserves. In prior webinars, I've talked about the operating reserve toolkit. And at the end, when we reference a website that we always send everyone to, the operating reserve toolkit information is there. There's one tool that I encourage all of you to think about as you start to embrace some of the ideas I'm sharing with you today. It is this idea of the operating reserve policies that the board may want to implement now that the disclosure requires external dialogue. You want to be clear, and I'm not suggesting that boards create designations if they don't exist right now. I'm suggesting that the board has the reserve policy. If it's always been in the spirit, we will not touch the reserve account for any reasons other than A, B, or C. Now, in deciding whether it gets reduced or not and how it gets explained, you'll want to know whether you have that policy or not. So that's something to think about. Two areas here, whether you have board designation and whether your temporarily restricted net assets, in fact, are for general expenditures. The last part of this is this idea of within a year. And we know that we might have time restricted, this was an abbreviation for us, temporarily restricted net assets. We might have a 2-year grant. And a 2-year grant means that it's $200,000 for the next 2 years at the end. Let's say it was a 3-year grant and you have 2 years left over. I can only spend 1 year in the coming year. So you would have to adjust by any restrictions more than a year. In the assets, there's also receivables that may be for more than a year. And in some cases, these may be one and the same if it's the same grant that's in receivables and it's in restricted net assets. If we have long-term pledges, they're not available. So taking aside all of the technical terms that we use to describe all of this, the essence is, do I have it? Is it available for me to pay my bills within the next year? And those are the steps to coming to terms with what is my financial asset balance available. Here's an example that, again, is a combination of what's in the ASU and some other examples we've seen. This is the quantitative piece of the disclosure. And so I encourage you to think about 2017 as your dress rehearsal. Draft these financial disclosures just for yourselves and for your board. And as I heard the thoughts of some folks who have already started to do this, you start to ask yourself, well, gee, is that restricted or isn't it? Is it for general operations? And so interesting what you'll go through as you attempt to do this for yourselves. Notice that there are 2 years on the top. When you implement this in 2018, again, 2019 is when your audit will be issued for your 2018 year. You'll need to do this at the end of 2018 and the end of 2017. Comparative, if you have a comparative audit, which I assume most of you do, you're going to be preparing disclosures for both years, which is why thinking about this at the end of this year, 2017, and starting to draft that one column will be a way to tease out questions. So you'll list all your financial assets, which again, if you look at them, they look pretty familiar as current assets. In this case, investments are in here because they're, in addition to the current assets, they are liquid. And so we're counting all of these items. But then we ask ourselves, well, do we have any long-term pledges in that pledge receivable? Yes, we do. And this amount is long-term, so we need to reduce that. Do we have any endowments? Yes, we do. The $2,055,000 is actually the endowment fund. So we cannot count that. The endowment is not available. But there's a portion of the endowment that is available. The annual appropriation, which is set at the beginning of the year based on a board approval, we can spend the appropriation for the year. So we get to add that back. Then we ask ourselves, well, how about donor restrictions? Do we back them all out because they're not available? Actually, no, there are some donor restrictions that are available. Some net assets, I should say, are available. So we get to include those. And then lastly, with board designation, is there an operating reserve that says these funds are to be maintained in a separate account and to be accessed only with explicit board resolution? Yes, we do, and it's 225, and right now it's sitting in our cash balances. So we have to back that out. So I start with $3 million, but I really only have $662,000 available for general expenditures within 1 year. Then it gets tricky, right? It's not only for the liabilities, it's liabilities plus like our general future and of this 1 year. And I know many of you don't have your full year's budget sitting in the bank or receivables or pledges. So there's going to be, I think, some sort of side analysis that let's say you're a $10 million organization operating budget. How do I feel about the fact that I have $662,000 available at the end of the year and there for me to meet my liabilities? That might feel low. If I'm a $1 million organization, I might feel much better. So the quantitative calculations look like this. How about the words? What does the qualitative disclosure look like? Here's where you actually talk about your policies around how you access liquidity. And the footnote could start, again, these are not prescriptive. These are just ideas and examples. The footnote might start by saying there's a seasonal nature to our work. And during the year, there are periods where we might have a need for cash more or less than other times of the year. So part of the disclosure shares with the reader, do we have a credit line? And the audits today tell us that. It's in the footnote. You might have drawn it down. It's on the balance sheet. But this is more a financial story about liquidity and access. So we have a line of credit of $100,000, and it's drawn upon when we need it, and it has to be repaid in full by the end of the year. See note Y. So think of this disclosure as a little bit of management. In the for-profit world, there's something called MD&A, Management Discussion and Analysis. And it gives the leadership an opportunity to talk about how they think about liquidity. So this organization is lucky enough to say we have a line of credit. If something, we have a bump in the road with delayed government payments, we can come back to this line of credit. We draw on that line of credit when we need it. The second part is this connection to do we have donor restricted amounts or not? So as we continue the flow of the disclosure, the organization has the $662,000 that we saw in the previous slides available. Those have already been reduced by anything that's not available within 1 year because of donor imposed restrictions or internal designations. They do include some board approved appropriation for the endowment. So as I walked you through that picture of the numbers before, these are really the words behind it. And it also includes, in this discussion, they decided that they would include some donor restricted amounts that are available for general expenditure. It also says that amounts not available and set aside for operating reserves are not included because that would require approval from the board. The action would require approval from the board. Now, in prior conversations, when we've talked about board designated funds, we've actually talked about, well, Is a board designated fund really restricted? Can a board change their mind? Yes, a board can change their mind at any point. And next year, if things were a bit tighter and the organization needed more availability of resources, the board might tap that reserve and say, rather than 100,000 in the reserve, we will bring it down to 75,000 and make 25,000 available because we don't have a line of credit. And that's fine. And the board would have a different designation and a different policy around that. So what the board does today is just that. What the board does in the future is what they decide to do. Here's why the disclosure is requires that the board be very clear as to what we want to do with those dollars. I personally sit on a board, and when we had our audit committee meeting this year, the audit team turned to us, to the board, and said, you don't have a board policy right now. The cash is in the bank, and you have decided certain parameters around it, and maybe that's all you need, and you just have to articulate that. If you want to take this as an opportunity to say, well, we don't think that we would tap into that balance by more than X because we would like that balance for more of a longer term plan, then that's what we would disclose. So our job this year at a board, which only meets 4 times a year, is to think through what is the policy. And someone who was presenting at the AICPA conference said, he's actually a controller of a major university. He said, you know, there's a lot of rabbit holes that you can go through or into with these issues. Don't overcomplicate your disclosures. Don't overcomplicate your policies, but be clear on what your policies are. If the board doesn't have a designation around those dollars and every dollar is available for future needs, then that's the policy. So I want to be clear that I'm not encouraging complications more than we need. So the qualitative piece are the words, the quantitative piece are the numbers. Just to remind you, when does it take into effect? It technically takes into effect December 15th, which often these guidelines talk about the fiscal years that begin after December 15th. So therefore, this would be January 2018 or any fiscal year that starts sometime in 2018. December 31st, any fiscal year with June 30th being an example. If you haven't had your meeting with your audit committee yet this year, I encourage you to ask your auditors to help you think about how you should be thinking about it. I think most audit firms, this is a standard part of their presentation now, so they'll probably start the conversation even before you do. So in sort of wrapping up before we open up for questions, how do we prepare for this? How do we prepare for all of the discussion points? And again, this is one of 5 changes. This is only on liquidity and resources. I encourage you to start with educating the board members and the leadership on the requirements. Have your audit firm come in and do a presentation for you. Seek outside advice. Get the board to understand what the issues are across the 5 areas. But again, in many of those other areas are all around financial statement presentation. This one is about disclosure of policy. So this takes a little bit more preparation. Clarify the intentions. Review the board designated policy if you have one. If you don't have one, challenge yourselves to say, well, how do we really intend to use those funds? And in the temporarily restricted net assets, as you close the year, even if you're doing audits now for December 2016, start to ask those questions around what kinds of restrictions do we have in the temporarily restricted? Are they of the type that would cover our operating expenses in the coming year, or are they of a different type? As I mentioned, seek advice from those who understand attend these webinars, listen to it again, share it with your leadership team. And as I said earlier, use 2017 as a dress rehearsal for how these financial disclosures will look for yourselves. The financial statement disclosures are typically only at the end of the year, but you may want to draft them just sort of leaving bookmarks of the amounts that you would want to put in. And when you get to the available financial assets, just take a step back and look at that number, compare that to the size of your operation, and then be prepared to I wouldn't say defend, but to expand on your story should others have questions or concerns about the balance in that account relative to what you would need. I would like to open the floor up for questions, and I will then just reconfirm some resources before we wrap up. So Ruth, you're managing the questions. If you have any, I am ready.
We have lots of questions. So I want to start with some more general questions. One question that we were asked repeatedly is, does this apply to all sizes of nonprofits? Is there a certain revenue, kind of a revenue limit where if you're bringing in, say, $300 a year, you don't have to do this?
So this is part of the accounting standards that fall under audit requirements, right? So you may do this internally if you so choose, but this is really part of disclosures in your audited financials. So if you are of the size that you are required to have an audit today, and again, we're in a really special state here in New York, as of next week, as of July 1, 2017, New York is going to $750,000 a year, where it used to be $250, then it became $500, now it's $750. So it goes with that audit requirement based on what state you're in.
Right. And then another question, which was, well, there are two other questions that are related. One is, how does this relate to our 990 report? Is there any relationship between the two?
So the 990 will have to be redesigned. Lots of fun for the IRS. To follow the disclosure requirements around the donor restrictions, especially. So the 990 has always required a functional expense statement, and these disclosures are not going to be attached to your 990. But the way that things are presented for things other than this disclosure, the 990 is going to be redrafted to follow those requirements and the instructions on investment returns and some of the other things that we talked about. This is not necessarily going to be manifested in the 990 in terms of additional disclosures. They will stay in the audit.
Okay. And just one other question related to this is, who's going to be interested in this? Who's going to be looking at these? So in other words, who's the audience?
So anyone who today is the audience for your audited financials will be the audience for this. And what we normally see, the board members need to be fully aware and understand these disclosures so that they understand their own financial story and they can tell that story. I always say that anyone who raises money for an organization should understand its audit and be able to tell what that audit tells in a pretty consistent way across the organization. If you raise money from foundations that require you to submit an audit, that's going to be an audience. And I think for foundations, sustainability is top of mind, liquidity, ability to pay bills. And again, this is the concept, not that this is all so black and white when you look at the documents, but they're interested in your liquidity and your availability. And then if you were going before a bank for any lending possibility, they would be interested, which is really where your audit comes in today, and for the most part.
Right. So for organizations, and this has come up in a couple of questions from people who are listening, in organizations that are really function hand to mouth, this might be a somewhat terrifying prospect to actually put down how you might, what your policies are around managing cash flow that now looks utterly impossible. Can you talk a little bit about how those organizations might want to approach this?
That's a great question, and I would say that I'm going to go back to my previous slide here. Those organizations, when they do this calculation and they have $25 at the end, because they have very little cash and they operate, as you said, on a tight basis. Hopefully, they have a line of credit, so they can talk about the line of credit here. If they have some receivables, which many organizations operate tightly on cash, but it's not because they don't have receivables. It's that they do business with entities that are late payers at times. And those receivables are going to be in there. And so sometimes a receivable can take 90 days, 120 days to collect, but nonetheless, they will be there. So it will, in some ways, not even disclose the severity if a receivable is a slow payer, because it will be there. So disclosing the line of credit, there may be a policy around quarterly analysis of cash availability. In essence, what can they say in this footnote to the reader that would assure the reader that the board manages operations closely, monitors cash balances, has sufficient credit line for its needs. I think this is assuring the reader that yes, our available financial assets may be low, but we work very cautiously and carefully not to overextend ourselves. And the one point that came in from the audience was that the policy is we will not go into debt. That's how we limit our risk. That's a great disclosure. If we cannot flow the cash ourselves, we will not go further. And so it's about how closely it's being watched and the board's engagement. I think these disclosures very much speak of the board. And there was a question at the conference, well, what if management has been given authority to do all these things? Can it just be what management does? And I think there would have to be a disclosure that board has delegated this authority to management. I think the standards are intended for it to be real clarity around oversight from the board.
Right. So, there's a funny dynamic that happens when regulations come down from on high, wherever on high happens to be at that moment. That if it's viewed as a regulation and you have to do this, it may in fact cause a little bit of sidestepping. And can you talk about what it is that this particular regulation adds to your potential management discussions around money? Because I think that there's a reason why this was added to the guidelines. And can you talk about how to kind of approach these questions in the most productive possible way and what they should mean to an organization who's having this discussion?
So I realize that whenever something has to be done because someone makes us, we can come to it from that perspective, and that's obviously necessary to get it done. I think particularly, and again, I feel like this is somewhat confirming what we've always thought with the Luna concept, that a balance sheet may look really strong because there's a building that makes us look like we're a $5 million asset organization, but it's not $5 million from an ongoing operations. And so I think why it's here, to answer that point as a framing start, it's here to shed light on the difference between assets and liquid assets. For the boards, for anyone who reads the financials. So We are 5 million, but we really are only a 500,000 liquid available asset organization. So for those that had heavy fixed assets, I think this sheds light on the liquidity factor. For those that have board designated funds, there's more on the disclosures of that that I didn't include today, just to focus on this piece. But there's a real interest in understanding the way the board is functioning in its oversight capacity. What are these board designations for? I've often in my trainings talked about the rainy day fund, but nobody ever defined rain. And so I think the goal is to clarify, extend intentions from the board with respect to how funds should be used by the organization. Clarity. If you look at audited financials and there are board designated funds today, you might see some that indicate what the purpose of the fund is. Sometimes they're not even shown separately under the category of unrestricted. So I think the goal by identifying board designated as an area to really disclose is to shed light. Again, nothing, it's not a gotcha kind of requirement. It's an understanding. How is the board determining the use of those resources? So if I'm a grant maker and I read this, I understand what the board's long-term plans are. Sometimes, we've been focusing on organizations with very little available resources. Some organizations face the fear that they've been working really hard to build a reserve or just a nest egg, and they fear that funders will say, well, you don't need our funds because you have these reserves. And I always encourage folks not to think that way, because funders don't want to fund organizations that are not sustainable. So if you do happen to have a large balance, this opportunity allows you the place to talk about what this reserve is for. It's for the future, it's for capital. And then when a funder reads it, they would say, okay, well, that's a responsible thing to do. I won't get the call when the roof leaks. So the reader is focusing on understanding the way management thinks about it. This should be something that every management and board team does already, but this allows you the opportunity to be able to disclose it more publicly. And they should take it that way.
Right. We have so many questions about how to, and I feel like you've answered this, but we have so many questions about how to portray the degree of control the board has over designating a reserve as able to be used, as when is it able to be used? Can you just one more time kind of clarify what it is they're looking for in this disclosure?
So they're looking to know whether the leader of the organization has access to those funds on an ongoing basis for ongoing expenditures. If the leader has to go for a board resolution to change the policy to request a special drawdown from the reserve, then those funds are not generally available. I always describe what is available on payroll day. What can I count on when I need to make sure that I can cover my payroll? If I have to go to my board and ask for a special transfer from the Fidelity account, and that requires an emergency board meeting, that is not generally available to me. And so it's from that place whether the board has made those dollars available for any purpose at any time. Some boards are fine with that. Other boards choose to restrict access to those funds so that access actually requires a conversation. Again, a conversation that once had makes the funds available. So the clarity, this is the one thing that I think is valuable. It's this question where the board actually has to ask itself, Are we okay with these funds being available for any purpose? Or have we always thought, no, we want to keep 300,000 for long-term needs, not for this year, but for the future? So maybe a way to think about it is, how much does the board make available for ongoing needs within this year? And how much does the board want to store for the future? And that's where the conversation with the board becomes important, that then leads to a policy. The operating reserve toolkit that I mentioned, we actually have a tool that I will share with you, and maybe those who are on the call can get a copy of it, where it kind of walks you through, if you're thinking about a board policy, what are the questions to ask? And there are quite a few, but then it goes along with the reserve toolkit to help you articulate that, and that might be helpful.
Okay, so I've got two more questions I'm going to ask real quickly. And one of them, I'm just raising this because I think it's probably a question going through a lot of people's minds. And we have three questions about it on the board here, which is that if going through this disclosure process and the development of the policies actually indicates that the organization is insolvent, how do you manage that discussion with your board? I mean, in some cases, you really do have organizations that get out on a limb as they're trying to either get started or recover from something. What is it that how should people manage conversations when they're going into it with an understanding that in fact it might be a pretty scary scene?
So if this were my disclosure and I came up with 662,000, and then I looked at my balance sheet at the end of 2016, and I have 800,000 in liabilities. Forget about next year. This is what I have right now. That would tell me that I don't have enough liquid resources to pay these bills, not to mention the future. Managing that conversation, again, these disclosures should not be anything that surprises folks. Hopefully they knew this going in. The question is, how are we going to balance that? How it's a little bit of a turnaround conversation. Liquidity is representative of health. So if we don't have that health, how can we stabilize? We certainly want assets in this disclosure to be greater than current liabilities at the very, very minimum, meaning we have at least enough available resources to pay our immediate bills. That's not here. Liability is not on the face of the disclosure, but it is on the footnotes, it is on the face of the balance sheet. And it doesn't take very long for someone to connect the two. And so if there is this shortfall, I do think that the organization and the board will have a conversation, I'm sure, with the audit firm, who this may lead to a different conversation, which is the subject of a different webinar, which is the going concern qualification that auditors sometimes are grappling with because organizations have liabilities that exceed assets. And those auditing standards are changing, making that a more imminent conversation. So I think if you're in that situation, you would want to be prepared to convince the audit firm so that they will be comfortable with a clean opinion that you do have a plan to turn things around.
Right. Okay, so, and I do want to make the point that for those even that are not required to do an audit right now, that this discipline is actually one that's very useful for organizations to just get a sense of who's comfortable with what level of risk even. This is a useful conversation. And how should risk be managed? One more question, Hilda, which is very short, and it's a plaintive question from one person who's been listening, is this is a good thing, right?
I think it is, but then I have to kind of curb my excitement sometimes. I think it creates clarity where sometimes there isn't. It's sort of like taking your medicine. It's forced because it's required, but then hopefully it will lead to the right conversations where the board sometimes doesn't totally understand the situation. Maybe the way this will help them. And again, they're not all bad. Some are good conversations.
Right. Well, thank you very much, Hilda. And I hope that the many hundreds of people who are still on the line, actually, will join us at our LinkedIn group. For those of you who did not get your questions answered, you can get them answered there. We're going to run that LinkedIn group for 30 minutes live, and then you can log in your questions after that, and Hilda and Gina will keep an eye out for those questions over the next few days to make sure that all of you do get your questions answered. So again, to join the LinkedIn group, you want to go to the LinkedIn group Nonprofit Quarterly, not the individual page, but the LinkedIn group Nonprofit Quarterly, and log in there. I do want to say that, again, this was brought to you free by AccuFund, but we really rely on your support. So we would appreciate if you consider us for a donation. We are always looking for the direct support from our readers and from our listeners. So please make a donation today if this was useful for you. And for those of you who keep asking us, are we going to do webinars on the other aspects of the new guidelines? I will talk to Hilda about it. Right, Hilda?
Yes, ma'am.
And we'll figure it out. Okay, thank you very much for joining us, and thank you so much, Hilda, for this very clear presentation.
My pleasure. Thank you.